You see a classic blue chip stock pop, like just over 2% on a massive earnings beat. It gets $158.04. The headlines are glowing.
Right, everyone's celebrating.
Exactly. But then, beneath the surface, the technicals flash a very clear sell signal, and the CEO is quietly offloading millions in shares.
Yeah, which completely contradicts the hype.
Right. So is this stock a wildly undervalued opportunity or, a carefully disguised value trap?
It really is the ultimate market paradox. I mean, we're so conditioned to cheer for the headline numbers, but the machinery underneath is, well, it's often telling a much more complicated story.
Welcome to today's deep dive. We are focusing all our attention today on PepsiCo. Ticker symbol is PEP. The date is April 16th, 2026, and we have a truly massive financial dossier to get through.
Yeah, we're talking detailed income statements, balance sheets, technical analysis, and some incredibly revealing market sentiment data.
And real quick before we get into the weeds, if you are watching this deep dive on YouTube, please take a second to like the video, subscribe to our channel, and leave a comment below with your feedback or, your own take on this stock. We actually read all of it.
We really do. And our mission today is to look right past that recent Q1 daily pop. We need to decode the conflicting signals this data is throwing at us.
Right.
We are going to break down the bull and the bear cases side by side so you can understand the mechanics of what is actually driving the stock.
Absolutely. Now, a quick but very important note for you listening. This deep dive is an exploration of financial data for educational purposes only. It is not financial advice. We're just two people sitting down for a natural human debate about what the numbers are doing and, honestly, what they're trying to hide.
It is always the hiding part that gets interesting.
Okay, let's unpack this. Let's start by exploring why the stock actually popped today. That Q1 revenue and profit beat was the headline everybody saw on their trading app.
Yeah, the top line numbers are staggering.
Seriously. I'm looking at this dossier, and we are talking $93.92 billion in trailing 12-month revenue. Their net income is $8.24 billion, and the operating income is $13.49 billion.
Which gives them a diluted earnings per share of $6. On paper, I mean, that sounds like an unstoppable machine.
And the cash flow looks incredible, too. Like, the cash flow from operations is a very healthy $12.09 billion. So they have $3 billion in cash just sitting there.
Yeah.
But, when you look at their liabilities, the story shifts.
It absolutely does.
Because having $9.543 billion in cash sounds great, but when you look at their liabilities, it's kind of like making a fantastic salary, but having your credit cards completely maxed out.
If we connect this to the bigger picture, that high leverage is the core tension here. Let's look at the assets versus liabilities. PepsiCo currently holds $107.40 billion in total assets.
Okay.
But against that, they have $86.85 billion in liabilities.
Wow, so that's a really thin margin.
It is, and here is the critical red flag jumping out of the dossier. Their total debt is sitting at 49.1 world, $8 billion.
Wait, $49 billion in debt?
Yes, which is an 11.01% year-over-year increase. It leaves them with a debt-to-equity ratio of 2.41.
2.41. So for every dollar of equity, they owe $2.41.
Exactly. And context is everything here. In the broader beverage industry, a ratio of 2.41 places them at the absolute bottom of their peer group.
But bottom, jeez.
Yeah, they are carrying a tremendous amount of weight. When you have to service nearly $50 billion in debt, it takes a massive bite out of that operating income we were just praising.
Right. So if the fundamentals show this mix of massive cash flow but heavy, heavy debt, how is the market actually trading it right now? Because the price action has to reflect that tension.
It does, and the price action is where things get incredibly muddy. It's exactly where retail investors tend to get hurt.
Let's look at the ranges. Over the last 52 weeks, the stock saw a high of $171.48. The low was $127.60.
Right.
And right now, it's sitting at $158.04. But looking at the technical analysis in our sources, it seems to be stranded in no man's land.
The moving averages tell that story perfectly.
Yeah, because that 158 price puts it below its 50-day moving average, which is at 160.35. But it's above its 200-day moving average, which is 148.69. It's just trapped.
It's a literal technical tug of war. The long-term trend is acting as a floor holding the price up. But the medium-term momentum is a heavy ceiling pushing it right back down.
And you can see the struggle in the momentum indicators, right? The dossier mentions the RSI and the MACD. DT.
Yeah, so let's break those down. The 14-day RSI, the Relative Strength Index, is basically an exhaustion meter. Right now, it's hovering between 43.2 and 51.6.
Which is totally neutral.
Pure neutrality. It isn't overly hyped, but it's not being panic sold either. But the MACD is a different story.
The dossier says the MCD is sitting at negative 0.23. That sounds concerning.
It is. The MACD is essentially the momentum engine of the stock. When it goes negative like that, it means the short-term momentum has completely fallen out from under the long-term trend. It is currently flashing a sell signal.
A sell signal, even with the daily pop from the earnings beat.
That is the crucial detail. Even though today's chart shows a green candle, the underlying engine is flashing a clear sell. And this is exactly why retail traders so often get trapped.
Yeah, walk me through that. Why do retail traders get caught in this specific setup?
Well, they see the news, right? They see the earnings pop and they buy in, completely ignoring the overhead resistance.
The technical ceilings.
Right. There is immediate resistance at 155.85 and a major cap up at 170.50. So the stock pops, hits that ceiling, and because the momentum is actually weak, it just runs out of breath.
And then it falls right back down to the support zones. The data shows strong support down at 154.09, or even a major horizontal support at 150.28.
Exactly. You buy at 158 thinking it's going to the moon, and 3 days later it's grinding down to 150.
That's brutal. What about short sellers, though? Is there any chance of a short squeeze bailing out the buyers?
Not here. The order flow shows short interest is incredibly low. It's only 1.5% of the float.
Which is what, about 20.48 million shares?
Yeah, and the days to cover metric is just 3 days, so there is no massive short squeeze on the horizon. Any upward pressure has to come from genuine long-term buying conviction.
Which leads us to a massive contradiction in our sources. If we need long-term conviction, we have to look at what the smart money is doing.
And they are completely divided.
Yeah. First, Wall Street analysts are leaning bullish. About 38% say buy or a strong buy, and 62% say hold. Nobody's saying sell.
And their average target is between 169.77 and 173.61.
Right. But then you look at the undervalued versus overvalued debate. Discounted cash flow models, the DCF models, suggest an intrinsic value of $261.95.
Which would be a massive 36% upside.
Exactly. But then the forward PE ratio is 19.1, which is very high for the historical beverage industry.
A forward PE of 19 implies the stock is fully priced, if not slightly overvalued. It completely contradicts the DCF model.
And here's where it gets really interesting. Let's look at the insider activity. In Q1 2026, insiders sold $5.75 million net.
That is a lot of internal capital flowing out.
It is. CEO Ramon Laguarta sold $4.68 million. The CEO of International Beverages, Eugene Williamson, sold $3.5 million. I mean, if the DCF models say the stock is a bargain, why are the captains of the ships selling their own lifeboats?
What's fascinating here is how we have to balance that narrative. Selling doesn't always equal panic, you know?
Right.
Executives get compensated in stock. They sell for tax purposes or just simple diversification. But, and this is a big but, when you combine that selling with a high forward PE of 19.1 and a MACD sell signal.
It forces you to question those overly optimistic DCF models.
Exactly. If the true intrinsic value was really $261, you'd likely see insiders holding tight to capture that upside.
Okay, so having looked at the numbers and the sentiment, we really need to lay out the ultimate debate here. The fundamental best-case recovery scenario versus the worst-case continuation lower.
The bull versus the bear.
Let's start with the bull case. The irresistible bait for investors is the dividend. PepsiCo is a dividend aristocrat. 54 consecutive years of increases.
That's a lot of history.
Yeah, and they just announced a 4% dividend hike, bringing the current yield to about 3.65%. Plus, they have a $10 billion share buyback program approved all the way through 2030.
Which provides a huge floor for the stock price.
Right. And they are showing resilient margins through cost cutting.
Yeah.
They have this one North America plan that's really leaning out operations.
And we can't forget the international volume growth. The dossier highlights massive expansion in Mexico, India, and China.
So the bull case is basically dividends, buybacks, and global growth. But the bear case, well, the bear case is pretty heavy.
It is, because it's not just the high debt. They are actively losing market share in the U.S. in key snack categories.
We're talking about legacy brands.
Right.
Lay's,
Well,
Tito.
exactly. The U.S. snack business is their historical engine of profitability. When those start losing ground, it's a huge problem.
And the expert analysis in the dossier introduces an even bigger long-term existential threat.
The GLP-1 weight loss drug.
Yeah, things like Ozempic.
Right. If these drugs fundamentally change global eating habits, the volume of snack consumption could permanently drop. They suppress the exact cravings that drive PepsiCo's most profitable products.
So what does this all mean for their business model? It feels like they're using international growth as duct tape to patch up a leaking U.S. snack business.
That is a very accurate way to visualize it. The international markets are masking the domestic weakness. But you can't outmarket a biological shift in your consumer base.
Okay, so synthesizing all this data to give a clear short-term versus long-term perspective, where do we stand?
In the short term, the outlook suggests it will test that 155 support level we talked about. Gravity is pulling it down.
So it needs a breakout.
Yes. A decisive breakout above 160 is needed just to retest the 52-week highs.
And the long-term view.
The forecast in the sources has it hitting 164.30 by the end of 2026.
Which is super modest compared to the current 158 price.
Very modest. It reflects the reality of the debt and the shifting consumer habits.
So to summarize the core tension here, PepsiCo is a cash-generating dividend giant trying to innovate, but it is heavily burdened by debt and shifting consumer health trends.
It's a battle between historical resilience and future relevance.
It really is. Thank you for joining us for this deep dive.
This raises an important question, though, for you to ponder. With the rise of GLP-1 drugs altering human appetites, will PepsiCo's 54-year streak of dividend hikes eventually hit a biological wall they just can't engineer their way out of?